It's a very quiet room. A bit like the oil and gas industry over the past 2 years, been a bit quiet. Thank you and welcome to Good Oil 2021. We were last here in this room in 2019. Last year was a bit of a blur, obviously, with COVID conveniently masking the fact that the oil price went to nothing. But we're all back. Who said the oil industry is dead? We're not dead. We are going very, very well. It's a funny world. For those of you that understand, we're here again tomorrow doing our battery minerals conference. So tomorrow we're talking up all that market. Today we're talking up energy with oil and gas. And what all these people that are in the lithium and the hard rock business and the energy business don't realise is that you need to have power to power all these bloody cars that are going to be around. So, and someone's forgotten that. So for the next 10, 20, 30 years, I think we're all going to be fine in the oil and gas business and the energy business. So let's hope that the discoveries keep coming, and let's hope that the share prices keep going up and all that you investors here can actually make some money. If you're brave enough to buy some stocks last year, on most stocks you'd be 5 to 10 baggers up now, because as you know, this time last year and a bit before, all the market was very poor. But it's good that we're here. We're also live streaming across Australia and all over the world. So we have registrations from Hong Kong and Singapore and at night time in Europe. So welcome to all those people. Welcome to everybody on the eastern states. If you can hear me loud and clear. Hopefully this is the forerunner of what Good Oil will then become in the years to come. We can get back here every year. So welcome to those. On that note, there are some companies that aren't here. And for whatever reason, only known to them, they didn't want to support this conference. I'm not going to tell you who they are. They know who they are. And you know who they are because they're not here. So 0 out of 10 for them. They're not team players. So all those that are here, thanks for supporting the event. Thanks for being part of the industry that we all love so much. Right, let's get on to today. We go through our sponsor list and, of course, Argonaut. Argonaut have been our sponsor for some time now, so thanks to Eddie and his team and their boosters over there. So one of the great supporters of the junior sector of the market, both in hard rock and oil. So let's thank them for being involved. We also have Lind, they're a sponsor from New York. They've been involved in all our shows for many, many years. And we also have Risk. Risk also speaking today. They're one of our sponsors and they have been for some time. So we thank Risk for being involved. We have a new sponsor this year. We have a coffee sponsor called Gallagher. And for those that don't know, Gallagher do insurance. They're possibly the biggest insurance company in our space in Australia. For those of you that follow vertical events and RIU, you'll know of our Explorers Conference. Well, Gallagher's have been sponsor of the Explorers Conference for many years. This is their first time at Good Oil, so thank them, welcome them, and go and have a coffee with them and talk to them about your insurance needs because they are right out there. Supporters, Geoscience Australia. Hello team Geoscience in Canberra. I hope you're listening in. They're talking a bit later this afternoon. Always good to have Geoscience involved because without data, without science, you have no industry. It's as simple as that. You can't start exploration until you've got some good quality data. And we're fortunate that in this country, both at a state level with a department here and in Canberra, we have one of the best data water governments in the world. So first class, well done. We also have Business Events Perth sponsoring us. Obviously, they're throwing some money at events here in Perth, so well done me to get that money off them. Fantastic. It's not much, but it's something. Helps pay the bills, and that's what it's all about. What I'd like to do now is to introduce to you our MC for the day, Chrissy Morrissey. You all know Chrissy from all her exploits on TV and around the place. She's done this show before, so I'd now like to hand over to Chrissy. Oh, sorry, and online. One point, online we have about 200 registered at the moment, I've just been told. So that's fantastic. And hopefully we have more during the course of the day. Back to Chrissy. Chrissy, over to you. Welcome everybody. Welcome Chrissy. It's great to be standing here again. It's great to have the Good Oil up and running. And let's hope it goes on for many years to come. Thank you.
Good on you, Stewie. Thank you so very, very much. I was so impressed by how quiet you all were at the very start of today. You hadn't even stood up, and obviously, Darren, my reputation precedes me. So as per usual today, all of our presenters, except for Darren, our first presenter, are getting 15 minutes. So Darren has 20. And there are a couple of things I just want to pick up on with what Stewie said just then. He said we've got 200 people at home on the Eastern Seaboard watching us. We've got 350 delegates who are here today as a definite, but we also had 25 companies who are registered. So thank God other people didn't come on board today, because otherwise we'd be having those post-conference drinks at about 7:30 this evening. So 5:10, we should be all out there in the hall doing bits and pieces. A big good morning to everyone. A hello to everyone who is online as well from the East Coast. Good Oil, the preeminent oil and gas conference, officially underway. Now, as opposed to the resources industry, there are a lot of people based, as we've mentioned, in the eastern states. So if you can bear with myself and Shane and our tech crew today, we've got a little bit of a mix as far as our presentations go. We do have some coming to us from the east, and all our presenters are watching us as the show goes on today. And one of the big things that we want to do here is we actually want to make you money. We want to give you positive investments. We want to make sure that you can buy tickets to the box in a couple of weeks to the grand final. $2.5K I got offered a ticket for in a box at the grand final. Well, myself and my husband got offered it, and I said, what do you think I said? No bloody fear. Poor man. So he's looking. Actually, I think Jackson up the back got standing room for Friday nights for $65. Is anyone else going to the final on Friday? Yes? Yes? A couple of you. Well, the rest of you, did you all go to rugby, did you, and spend all your day there on the weekend? Okay, fair call. All right, that's fair. All right, so if you're going to work with myself and Shane as far as the tech is fantastic. Listen attentively. We do have the contact details for all of our presenters if they're not here in the room. So they have got representatives out at the booth, so please speak to them. But if you feel you need that more one-on-one, we're happy to furnish you with their phone number, so don't panic there. What else can we tell you about? We talked about the coffee outside. Thanks very much to the team at Gallagher Coffee. Jackie is out there. She'd love to have a chat with you. It's all about raising the awareness of this fabulous brand, what it can do for us within this industry. They've also got a little competition out there. I don't know how you guys think you are at probability, girls and guys think you are at probability, but if you can guess the number of coffee beans that are in the jar there, I had a look. I don't think I've got a hamburger's chance in the proverbial, but if you can, you walk away with a bottle of Grange. And we've got some other giveaways as well, just to keep you interested and things going as the day goes on. All right, are you guys ready to get this conference underway? Yes, ready to make some money? Let's do this. Now, our first speaker is going to point us in the right direction for a couple of things with some data. He is Darren Ferdinando. He's from Basin Science. Now, Darren has completed a PhD at UWA, and his topic was the Northern Perth Basin. Now, it may not sound that exciting to you and I, but to Darren, it was very exciting, and it's driven a large portion of his life. From there, he joined the Geological Survey of WA. He moved into the Petroleum Division of the WA Mines Department. He started his real work after that with Arc Energy as part of a team, and they drilled over 50 exploration, appraisal and development wells in the space of just 5 years. In 2008, after Orr took over Arc Energy, Murphy Oil, who is a really large US independent company, they opened up an office here in Perth. They made you an offer that you could not refuse, correct? So he worked for them as the senior staff geologist for about the next 11 years, explored all the way around Australia, including the Great Australian Bight, Browse and the Vulcan Basin. So he's got a bit of a basin fetish, I'd say, as well as spending another 5 years working for the Perth Basin. This is going in the wrong direction, isn't it? In 2019, Murphy decided to circle the wagons, and back they went to where they've come from, back to Houston. This time they made him an offer. He refused it. So he went, bugger it, I know a lot about basins. I'm going out and I'm starting my own consultancy firm. And in that particular niche, the man is here to speak to us today because he has been very focused on mapping the regional play potential of Perth and the Vulcan basins to help assist in what we're here for today, petroleum exploration. Can you please put your hands together, ladies and gentlemen, for our first speaker, Darren.
Chrissy, thank you very much for that glowing introduction. So I'm here to talk about yet another resurgence in the Perth Basin. As you'll see going on in this conference, disclaimers are an obligatory part of every talk. This is mine. So I'd like to start the conference with a quote from Professor Park Dickey back in 1958. And I'll read this out. It starts as, "We usually find oil in a new place with old ideas. Sometimes we find oil in an old place with a new idea, but we seldom find much oil in an old place with an old idea. Several times in the past, we thought we'd been running out of oil when actually we were running out of ideas." And I think this quote encapsulates the Perth Basin. And there we go. So the northern Perth Basin covers the region between roughly Lancelin and Geraldton and includes the onshore areas and the offshore areas. Gas was first discovered in the Yardarino well by Whoppet in 1964, and until recently, the largest discovery has been the Dongra gas field with about half a TCF of gas. Then in 2014, the deepening of the Senecio 3 well beyond the primary target discovered the 600 BCF plus Waitsia gas field. And this discovery has been the catalyst for a number of recent discoveries that are targeting deep gas objectives. And it's interesting, in this Good Oil Conference this year, about a third of the companies that are presenting have some interest in the Perth Basin. So since the discovery of Yardarino and Dongra gas fields, there have been another 3 phases of exploration in the northern Perth Basin. The second phase included the discovery of Wadata, Bahara Springs and Mount Horner, and the third phase, which started in the year 2000, with gas discovery in Bahara Springs North, and also, more importantly, oil in Cliff Head and Hovia. The fourth and most recent phase started in 2014 with the discovery of Waitsia and has then been followed up recently by the gas discoveries at Bahara Springs Deep and also West Erregulla. I'm just going to step to one side for a brief moment and talk about creaming curves, because I'll be showing a few of these as we go through in the presentation. Now, creaming curves plot the cumulative volume of hydrocarbons discovered in an area against the amount of time or well count. And if we have a look on this plot, here's on the vertical axis, the cumulative volume, and on the horizontal axis, the well order. Now, these curves indicate how mature a basin or a play is, which is a way of estimating how much more oil and gas may be left to be discovered in the basin based on past results. And you can see on this graph here, the early period within this idealised creaming curve, lots of discoveries over a very short period of time in the frontier and emerging phases. Then as we get into the maturing and very mature phases, a lot more time or wells have passed, but it's only small incremental discoveries. Now, these creaming curves are just one of many tools that are in the toolbox of a geoscientist, and it can be used when assessing the hydrocarbon potential of a basin, and they're usually a very blunt instrument. But when used carefully, they can actually provide some really good insight into what has happened in the past and what may happen in the future. So this is the creaming curve for the northern Perth Basin. We can divide this into 4 phases, which is the Dongra Yardarino phase, the Bahara Springs Wadata phase, the Cliff Head Hovia phase, and then our most recent phase, the Waitsia West Erregulla Bahara Springs Deep phase. So phase 1 went from 1963 through to 1979, and I characterise that as the low-hanging fruit. Right? This phase targeted the late Permian Dongra sandstone play. That's a set of sands below a large shale seal that's about 255 million years old. And it was targeting features in very large structures, anticlines, big tilted fault blocks, easily visible structures. And that's because back at that stage, Whoppet generally only had very low resolution, 2-dimensional seismic data and gravity and aeromagnetic data. And this was, in terms of the Park Dickey quote, it was hydrocarbons being found in a new play in a new place. The second phase, I call stepping out, and no apologies to Joe Jackson for stealing the title of one of his songs, was the Warrago formation play. And this is a slightly older play that's sitting immediately underneath the Dongra play. It's around about 257 million years old. And this was still targeting large structures, but it was a new play. So still using 2D seismic, slightly improved seismic quality in the 1980s to the 1990s, but it's a new play in an old place. Third phase is the mopping up phase, and there's actually two components to the third phase. The first occurred onshore, and it was targeting smaller structures in the Dongara sandstone, the old play in the old place. Remember, not much oil is found in an old play in an old place, and that's what happened here. But when you say not much oil, the discoveries of Hovia, Jingamaya, Xyrus, Apium were all very profitable to those companies involved. It didn't take much oil in that period when oil was really high to make a good turnover for the company there. And this was helped on the onshore area by the acquisition of 3D seismic over the area. So they were able to target these smaller, more subtle structures. The second part to the third phase occurred in Cliff Head in the offshore area. A lot of work had gone on in the previous years and decades prior to that, and then when Cliff Head was drilled and discovered oil in the Irwin River coal measures, a much older play to the Dongara play, that's around about 275 million years old. This opened up a new play in a new area, in the offshore area, and that was followed up by discoveries at Dunsborough and Franklin, and also Perseverance. Phase 4 is the current phase, started in 2014, goes to now, and it's a phase of large gas fields being discovered in the deeper play of the Kingia Formation. Now, this is using a combination of high resolution 2D and 3D seismic. So we've gone from the low resolution, only able to image the larger structures back in the 1960s, to now this modern data set able to image deep, what were hard to image plays in the past. This is a new play in an old place. It's around that same area as the Dongara discoveries. And there are still a number of sizable discoveries yet to be drilled. And I finished this slide off yesterday, and I said, in the case of Lockyer Deep currently being drilled, and I've just discovered this morning, much to the joy, I hope, of MRL and Norwest, that Lockyer Deep appears to be an unmitigated success. Congratulations to both of those companies on taking that risk. So, what does this all mean? The northern Perth Basin has a history of new hydrocarbon-bearing plays being discovered and then being drilled out by the companies involved until the play becomes mature. These play types have increased in complexity over time, from simple structural highs in phase 1 to different sands but in similar structural settings in phase 2, and then in phase 3 to smaller, more subtle opportunities in proven plays, plus stepping out into new places with new plays that may have future potential in terms of the offshore Cliff Head style discoveries. And then in phase 4, unlocked new deep plays that were unable to be imaged in the earlier phases 1, 2 and partially 3. So to see what the future holds, let's delve into the details of this Kingia play and see what it entails. So, Senecio 3, a lucky well. I do believe Senecio 3 was a lucky well, but my definition of luck, I think, is going to be very different to other people's. Senecio 3 drilled in 2004 to test a tight gas discovery that was previously found in the Dongara sandstone, and then deepened to the Kingia Formation when AWE found they still had money in their drilling budget. The well had excellent shows over a thick interval of the Kingia Formation. And I believe this was a classic case of smart luck. And the definition of luck I use is a sportsman's definition of luck. Luck is the intersection of preparation and opportunity. And this is what happened. The preparation was undertaken previously by companies including Arc Energy, and Arc Energy was taken over by AWE in 2008. And a number of wells have been drilled by Arc Energy, including Cory Bass and Drachia 1, that in some cases were unsuccessful, in other cases not quite commercial. But a lot of those learnings were taken by Arc Energy, and a number of key staff were retained by AWE when they took over Arc Energy, and so that knowledge was passed on. That was the preparation, and the opportunity came through reduced drilling costs, and they took that opportunity. And hats off to AWE, because they had the good management to recognise the opportunity and take the chance, and it's paid off for them. So the current play is the Kingia Formation. What is it? The Kingia Formation is the name of a nearshore sand, so deposited just off the beach in the ocean there about 275 million years ago. And the excitement about this is that even at depths around 5 kilometres, These sands retain significant porosity, and it's due to a clay coating around the grains that has stopped them from being silicified. Other sands in the northern Perth Basin, including the Dongara and the Wodgina sands, generally tend to lose their porosity at depths below 2,700 metres. But the challenge with the king ear play is to find where the clay coatings are in the depositional environment, because it's not ubiquitous across the whole of the king ear formation. So what is this anomalous porosity that's making all of these exploration companies so exciting? What it is porosity is preserved in the king ear formation by a specific type of clay, an iron-rich clay, which coats the quartz grains and inhibits late-stage quartz overgrowth. And here's an example of one of those grains just down here. And this stops the effect that has destroyed the porosity in the Dongara sandstone at 2,700 metres. There have been a number of studies undertaken on this, and all of these propose models that involve shallow marine to estuarine deposition adjacent to fluvial input. And just here is one of those studies there, and it shows high concentrations of these iron-rich clays in the estuary area, and then out around the beach area, a lower concentration, but still a significant concentration. So to put this into easy to understand language, we expect to see these clay-coated grains, this porosity preservation mechanism in marine sands close to estuaries, river mouths, and delta fronts. So these areas would have the anomalous porosity preservation, whereas other areas where it's just a straight beach with no river systems coming through nearby are unlikely to have this mechanism and be subject to this porosity degradation that occurs around 2,700 metres. So what are the future opportunities for the king ear play? There are companies with acreage in the North Perth Basin that have identified a large number of opportunities along the Waitsia West Erregulla trend. These are all at depths greater than 3,000 metres. So I think within that portfolio of prospects, we're likely to see some really good additional discoveries coming through. And I can now cross Lockyer Deep off that list of potentials and put it into an actual. In the offshore area, 2 recent wells drilled by Murphy Oil drilled through the king ear formation, and they found these clay coatings, but they weren't effective. It wasn't quite close enough to a river input. So it wasn't quite the right depositional environment in 2 points in the offshore area. But there may be other areas offshore where this mechanism may well work. So this leaves us with 2 questions. How deep does the porosity preservation go, and where else can we find it? Right now, we don't know the absolute depth that this mechanism goes. We know it goes down to at least 5,500 metres from some of the West Erregulla wells. It may go down to 6,000 metres. It may even go down as far as 7,500 metres. That opens up a lot of acreage within the northern Perth Basin. And the other thing is, where else can we find it? We know in a couple of parts of the offshore, not quite there, but there may be some new places we can extend this play out of from this current area around Waitsia West Erregulla, possibly into the area offshore and possibly to the area south of where Waitsia and West Erregulla is. So there is a lot of potential for not just the identified discoveries we have at present, but also future discoveries in areas we haven't recognised yet. So not just the king ear, but let's look past phase 4. What possibly could we be looking at in phases 5, 6 and 7 in the petroleum history of the northern Perth Basin? There's an area to the east of the basin along what's called the Urella-Darling Fault System, and there the Dongara sandstone becomes shallow again at depths less than 2,700 metres where it can have porosity. This would be taking the old play around the Dongara-Hovia area and bringing it into a new place. Great potential exists in there. There's the Jurassic gas. I haven't spoken much about the Jurassic gas today. My apologies to Strike Energy. I think I've got some there. But this is a de-risk play. There have been discoveries in Gingin, Red Gully, Whalering, Warrago, Ocean Hill. The play has essentially been de-risked because we know gas can exist there, but it hasn't been systematically explored yet. And so this is a newish play in an old place. Great opportunity again. And then there's the more conceptual plays. There's a turbidite plays. Turbidites are generally mass wasting events on the ocean shelf where the sediment then drops off the ocean shelf and goes into the ocean deeps. Now, in between the early and late Permian, about 265 million years ago, there was a significant mass erosion event in the northern Perth Basin. And the question is, where did this sediment go? It didn't just disappear, It had to go into the basin deeps. And there has been some groundwork laid, the initial stages of preparation in wells such as Mount Adams 1, Munganuka 1, that have recorded in their well completion reports the presence of distal turbidites. So these are penetrations that are just on the edge, possibly, of these turbidite systems. Could this be the thin end of the wedge for unlocking this play in the future? And potential areas for this play include the offshore and the southern part of the northern Perth Basin, a new play in a new place. So how can we maximise the preparation component? Because the opportunity comes regardless of whether we're prepared for the opportunity or not, but the key is preparing for the opportunity. One of the things we need to do as geoscientists and also exploration companies is embrace the fact that exploration is inherently risky. Right? People talk about chance of success, but let's turn it around and look at chance of failure. The average Perth Basin well has a chance of failure between 70 and 80%. And even a good well, a low-risk exploration well, has about a 60% chance of failure. At a rough cost of $12 million for an onshore well, this can prove very expensive, but the rewards are there. To find a modest, Hovia-style, roughly 10 million barrel discovery, that can generate a return to the company of well in excess of $200 million. There's a reason that banks don't drill wells. There is risk in there, right? But there is great reward for those companies that persevere and approach exploration in a smart way. And you have to learn from both your failures and successes. Waitsia wasn't just achieved by a lucky well. Waitsia was achieved by leveraging on the lessons from a number of dry holes and sub-commercial discoveries, such as Corybas and Drachia, and integrating this data over a number of years. So a few unsuccessful wells don't invalidate a new play. In fact, the real failure here would be to not integrate this data and modify your models to then reflect the reality. The other key to maximising preparation is to get your hands dirty in the data. This is hard work. There is no two ways about it. It was mentioned before by Stuart about Geoscience Australia and West Australian Mines Department having a lot of data. They do have a lot of data dating back well into the 60s. Search through these old reports from WAPIT, the old well completion reports, integrate that data. There will be some really useful threads of information in there that you can apply to your models and improve those. You also need to avoid only looking at the shiniest new data that comes through. So just looking at new 3D data sets. There is a wealth of other data that'll help your interpretation on these data sets. And most importantly, to my mind, is that don't forget that the geoscientists of old, back in the WAPIT days of the 1960s and 70s, and then the Premier Oil and Metgasco days of the 80s and 90s, they weren't dumb. They just didn't have access to all the data and data handling tools we have today. And a common theme on this slide, at least, is make sure you integrate the old data into the new. That's how you're going to maximise your preparation when the opportunity comes. So, to conclude, Professor Park Dickey's 1958 quote, I believe, is still relevant 63 years later. And more importantly, we have to make sure we don't run out of ideas. The current king ear play is still emerging. In those creaming curves, it is still in the emergent phase, and I believe there are some very large discoveries to be made over the next 5 or so years, and I'm really looking forward to it. There are a number of new plays in new places that have the potential to drive phases 5, 6 and 7 in the Perth Basin. And I look forward to seeing the North Perth Basin continue to provide discoveries to those companies that are willing to put in the preparation that's needed to unlock these future hydrocarbon reserves in the Perth Basin. Thank you all.
You're a soft rock geologist, I've just discovered. Those terms absolutely intrigue me. So Darren, where are you? You're taking your microphone off, you're not even going to answer that statement. I've got 42 seconds left in which to grill you mercilessly. Soft rock geologist, we've had the official presentation. We now are armed with very bloody interesting information. How many years did it take you to do all of your research? Go on.
I'm giving away my age, but I've been working now in the Perth Basin for 30 odd years. And that's the key, is that you can have the skills, but having the skills to analyse things you also need the experience and the understanding. And it comes down to getting into the data.
Yeah.
I've spent a lot of time looking at the data. I know where skeletons are hidden, and that's quite important. That just takes time.
Yeah. Well, I think I can genuinely say on behalf of all of us, that was the most informative and interesting and passionate talk I've ever heard about the basin. It really explained it really well. Would you put your hands together for him, please?
Thank you, Chrissy.
I do in my career, in my life, have the honour of hanging around with a lot of rock lickers, but you're the most passionate one that I've yet to meet. So thank you very much for starting off our conference on such a great note. Really enjoyed it. All right, we're going to take some of that information we've learned, we're going to extrapolate it. We're going a little bit north. We're going to the northwest shelf. Thomson Nard, where are you, sir? Sitting in the front row, front and centre. Thank you so much. Now, Thomson is the Chief Financial Officer of Carnarvon. He's been with the company for almost 12 years, and during this time he has overseen the transition of the company from a company with assets through Southeast Asia to a Northwest Shelf focused explorer and now developer, following success at Dorado and the Buffalo Redevelopment Project. Would you please make him very welcome today?
Good morning, everyone. So Carnarvon focuses on shallow water conventional structures offshore Northwest Shelf. We've got a fair bit of activity around the Northwest Shelf going on at the moment, and today I'll be going through our key activities in the region, starting with where we are at the Dorado development. Then I'll move on to Buffalo and focusing on the Buffalo 10 well that we'll be drilling shortly. Then we'll be going to the very exciting bed out exploration campaign, which will be starting at the start of next year, firstly drilling the Pavo 1 well, and then the massive Apis 1 exploration well. I'll touch on further bed out exploration opportunity and quickly finish on our renewable diesel project that we've recently started. On the Dorado development, Santos have done a fantastic job getting us through the pre-feed process, in which we took 3 FPSO providers through a design competition. The same with the wellhead platform, there were 3 through that process. We formally entered FEED in late June, and only last month we announced that Altera has been awarded the contract for the FPSO, and Supura is for the wellhead platform. Dorado is looking really promising. It's as you've seen in a lot of Santos's press release, it's a low-cost project, and we're targeting really high production rates of 75,000 to 100,000 barrels of liquids per day. Dorado is a light, sweet crude. It's basically a really high cut in naphtha and the middle distillates. So the way I look at this is it's basically Tesla-proof. The naphtha and high cut of distillate means that a lot of the liquids go effectively to jet fuel and non-combustible products such as petrochemicals and solvents. So really it has a long time to live, this liquid. It's high quality. It's currently fetching a pretty decent premium to Brent. So we're very excited about that, and that contributes to the economics quite strongly. Our concept here is a wellhead platform and FPSO, as you can see on the image there. We've built quite a bit of flexibility into this project. The wellhead platform has spare slots available for future tie-ins and future drilling around the prospect itself. And also the FPSO has been designed to allow for near-field tie-ins for discoveries nearby. Quickly moving on to Buffalo. The Buffalo Redevelopment Project is up in following the Maritime Boundary Treaty with Timor-Leste. It's now in Timorese waters. This sits in really shallow water, about 25 to 30 metres of water depth, and this allows us the opportunity, as well as being in Southeast Asia now, to execute a really low-cost development, which is fantastic. Other unique features here is, while it is in Timor, the Timorese gave us equivalent fiscal terms to the Australian regime. So together with cost recovery, shallow water, we can really drive a low cost economic outcome here. Further to that, there is actually quite a lot of equipment nearby Timor-Leste, through Southeast Asia that's coming in to the end of their field life, and we've already started a process of identifying some of this equipment to bring to the Buffalo project post our well. So the well we're drilling, and our first step here is to drill the Buffalo 10 well. And I'm not a geologist, so I didn't give you a seismic image to think about, but how we see this opportunity is there was the previous development, which was initially kicked off by BHP back in the late 90s, sorry. And there was a lot of trouble with imaging seismic back in those days. And just through the passage of time and the improvements in computing power, we can now really image the structure really nicely. And what we've identified through our work over the years is there is quite a fair bit of up-dip attic oil here. So we see a large piece of the structure above the highest perforation. That's demonstrated on this image here, where Buffalo 7, one of the 4 main production wells, there is effectively an up-dip portion there, and that's really what we'll be attacking in Buffalo 10. And our 2C resource there is about 30 million barrels. And as I said before, given it's we can execute a low-cost development here in the order of about $100 million, and really cheap OPEX here being in Southeast Asia, 30 million barrels is very, very material, and it's actually got a similar value to Dorado from that respect. Moving on to the Bedout Basin, Pavo is our first big exploration well that we're drilling following the Dorado success. Here we have a mean prospective resource of 90 million barrels. And what's important to know in Dorado, and you'll see this in a couple of slides' time, we see this as having 2 different sources. So from a risk perspective, we're quite excited about this one, managing the risk there. And also, it's not just about Pavo here. To the southeast, there's a continuation of this play. So if this works, we'll be able to continue drilling further exploration wells all the way to the southeast. On top of that, we've got some pretty interesting sands deeper towards the Permian here. So we're really thinking about drilling our well further than just the Kalima sandstone, going deeper and testing that Permian, because that'll have a pretty significant impact on going deeper. Now I move on to Pavo, onto Apis, the big kahuna. If this thing works. There you go. So Apis is just simply massive. At 235 million barrels of liquids plus half a TSF of gas, we just have to drill this thing. It's towards the south of Dorado, and those volumes of 235 million barrels does not include the Apis trunk and some of the other structures very nearby. This thing's simply massive. I mean, this is why we do this. This is why I'm in oil and gas. This is why I'm at Carnarvon. It's such a good well. We're going to get after it straight after Pavo. We expect to be drilling the Pavo well in around January of next year. Santos are currently finishing up their Bayou campaign. They'll be moving the rig, the Noble Tom Prosser rig, onto the Dancer 1 exploration well. Then it will be coming to Pavo and then straight to Apis. Once again, like with Pavo and Apis, they both have a significant amount of running room. So you can see the regional map there to the southeast of both Pavo and Apis. There's a continuation of the trend there. And we really see this basin as having 6 key fairways. In the center is where we have Dorado and the previous Rock and Phoenix discoveries. There we're finding a real mixture of oil and gas. As we go to the southeast, it's more liquids rich. As we go to the west, it's more gassy. We'll be attacking that when the time is right. But for right now, we're obviously focusing on Pavo and Apis. To the north, you can see some quite sizable prospects, so we're going to go there soon as well. But what is key here is, in the entire basin, we have identified over 90 valid prospects. 30 of them are in the Kalima sandstone, much like Dorado, and there's 60 prospects in other play types. So those other play types, why they're important to think about is in Pavo and Apis, we're both probably going to go deeper and start testing what we have towards the Permian, and that will start lighting up those other plays in this area. So I think in Darren's talk, in one of his earlier slides, he talked about the creaming curve in basins. We are really just at the beginning here. We've only drilled 6% of this basin. There is so much more to do. Recently, we also completed the Carnarvon 3D acquisition, and in that polygon there, you can see that's towards the east of Dorado. Really, that's our eastern fairway. That thing is just littered with structures. On 2D, a bunch of those structures were intersected. They look really promising. A lot in the Kalima as well. In fact, some of those structures don't even fit in between the 2D lines, so we don't really know how many we have, but we're pretty confident there's somewhere between 30 to 50. So once we get that 3D in, we're going to have a really good hard look at that area. And I suspect, you could have anything like 10 Dorados in there. We just don't know, but it's pretty exciting, and I suspect you might see our next exploration campaign towards that region. Just moving on to one of our recent developments. A couple of months ago, we announced that we're commencing a renewable diesel opportunity. What does this mean for Carnarvon? Well, obviously, we don't have a head in the sand with respect to where the world's going. We have a really, really impressive portfolio at Buffalo and Dorado. Things like Buffalo, that we want to get that onto production 2023. It's got a really flush production period of 2 to 3 years, and it's going on a steep decline. But Dorado's not too dissimilar, and the surrounding acreage we'll be expecting to produce most of that, by 2030, and really we've got to look towards going to net zero by 2050, which Carnarvon has now committed to. So how does renewable diesel tie into that? Well, we see this as actually quite complementary to our existing portfolio. It's still a liquid product, much like what we're chasing in Buffalo and the Bedout sub-basin. And also this works in conjunction with our portfolio, because the way we are seeking to do this is by using sustainably sourced fuels. And we've got the objective of generating our own ACCUs for this, and that'll assist Carnarvon into getting to its net zero commitment. What is renewable diesel? A few people have asked this, and there's a bit of confusion between the differences of renewable diesel and biodiesel. Renewable diesel, the key is it has to be sustainably sourced. So in Western Australia particularly, there's a lot of waste wood and other sorts of biomass that simply get burnt, and then they create CO2 themselves. We've identified a process whereby we can convert this into renewable diesel. And the other important thing about renewable diesel in comparison to biodiesel is that this can be dropped straight into motors. It doesn't need any further processing. It doesn't need any blending. It's just ready to drop in. We're pretty late in the stages of getting that certified by important users of this product, such as CAT, and it's all looking pretty promising so far. So in summing up, Carnarvon, we see ourselves as really stacked with near-term catalysts. It's been a little bit quiet on our front over the last 12 months. We've had our heads down working with Santos on the Dorado pre-feed, working on identifying our contractors, but we're there now. We've started the feed process. We're targeting FID for the middle of 2022. That's all on track, and that's great. Otherwise, it's time to drill some wells, So it's a bit like getting to the bus stop, pressing the button, and the bus is 10 minutes away. And over the horizon comes your first cat bus. But we all know what cat buses are like. When the first one's coming, the second one's over the horizon. So we're spudding Buffalo in 7 to 9 weeks. Just in early January, we'll be spudding the Pavo 1 well. And then not long after that, we're spudding the Big Apis well. So ladies and gentlemen, strap yourselves in. It's going to be a wild ride.
Geez, Darren, you may not be, like yourself, a geologist. You may be a mere bean counter, but he got a bit excited there at the end, didn't he? He's also a cat bus director. Hey, thank you so much. Have you just come away from the thing over there, so we can just say that officially your presentation has finished. But I would like you, please, as a bean counter, to tell me how many beans you think are in that jar out there for the bottle of Grange. Just quietly. Any ideas?
There's about I think Kevin Gallagher put the numbers out. There's over 2 billion beans worth of oil liquids in the Bedout sub-basin. I think about 7 TCF, so it's all pretty exciting.
No, he's just focused on his presentation. Did you notice that? I'm actually focused on the bottom of Grange. So outside, there's a container with beans in it. Those beans.
I've not even looked.
Go, sit down. Mate, thank you so much. Please thank Thompson. Exciting stuff happening up there. I love it. He's an accountant. He's focused on the bottom line. Now, notice a couple of you have come in as our speaking has begun. You missed the best speech this morning from Darren, followed by Thompson. But if you'd like to come down and sit down the front here, we have some chairs, complete with tables and writing. So please come on down. Don't stand at the back and feel you have to stand on finance on that chair. Mark Freeman, would you like to join me up here, sir? Now, I knew our next presenter up on stage about 30 years ago. This man was a hard-nosed personal trainer, paying his way through uni. He's turned into a respectable accountant as he takes to the microphone. This is a double act he's doing for us today on behalf of Kalima Energy. Mark is he's the finance director. He is a chartered accountant with more than 20 years experience in corporate finance and the resources industry. He's the FD for Kalima Energy. He has experience in strategic planning, business development, mergers and acquisitions, North American gas. You've been pretty busy since I last saw you all those years ago. And he's worked with a number of exceptionally successful public companies. I'm going to let him introduce the rest of it, also introduce you to his co-presenter, who is Shane, who is over in Canada at the moment. Would you please make Mark very welcome, everyone?
Thank you all for your time today. I am the Finance Director for Kalima Energy. Now, I've been involved with Kalima since 2015, and I have to say that right now we're in the strongest position we've ever been in. We've built a strong position in Canada. We have three main assets. The Montney, which is our rich wet gas up in northern BC, and the Brooks and Thorsby, which are conventional low decline assets which have very strong economics in Alberta. We chose Canada for three main reasons. Number one, it's a tier one jurisdiction. Number two, they've been producing oil and gas for over 100 years. And number three, we found they are the best people to work with. This provides us with a phenomenal energy asset base that can generate tremendous free cash flow, and we can ramp up as energy prices increase. The assets that we have at Brooks and Thorsby are tier one. They have all-in costs of $26 per barrel, so that's including costs of drilling and completion, and their operating costs are very low, $10 to $12 per barrel, which makes them very strong with oil prices at $68, $69 a barrel. At $69 a barrel, the business makes tremendous amounts of money, and I'm a big believer that the oil price will continue to grow. We feel that, along with our other analysts, that we can see $100 oil, and at that price, we're expecting our multiple of our company to grow somewhere between 5 to 10 times our current valuations. Most interestingly for us, we have a significant upside in the Montney. Whilst Kalima did enter the Montney early, we are the last independent holding with over 60,000 acres in northern BC. Our acreage can be converted to the main grid through a 100% owned Tommy Lakes facility we have to the north, with a very small 12-kilometre pipeline, giving Kalima shareholders significant upside to the Western gas market. We trade on the ASX under CE1. Current market cap is around $100 million with 500 million shares on issue. Analysts have us between 50 cents and $1.50 per share. Current share price is around 18.5 cents. A good reflection of our business is the $25 million facility that we have with National Bank of Canada. That provides us a very low cost of capital at 4%. And it also gives us significant ramp-up capability. So we can draw on this facility and pay it back as and when we need it. We are a development company with 3P reserves of 25.7 million barrels of oil. And in a short 4 months, since we acquired Black Spur, our production has grown from 2,500 barrels a day to 3,300 barrels a day. With gross revenues last month of 4.5 million, we had net revenue of 2.5 million. So our ability to grow is substantial, and we believe within the next 12 months, we'll be able to pay dividends and do a cash buyback. We're now drilling 3 wells at Thorsby, which will grow our December production exit to around 4,500 barrels of oil per day. Our current objective by the end of next year is to get to 5,500 barrels of oil per day. But realistically, we believe we can get there within the next 8 months. What makes Kalima's story so believable is that not only do we say we can respond quickly to take advantage of the oil market, but we do just that. We've drilled 6 wells in the last 2 months, and we've got 1 to go. And our wells can be put on production within 30 to 60 days. In addition, we're continuing to look for offsetting acquisitions to grow our production base. And once again, I mentioned we've got the ability to unlock the Montney value. Our growth phases are focused on increasing production ultimately to 10,000 barrels of oil per day. We have over 140 locations at Brooks and over 100 locations at Thorsby. As you can see from the resource breakdown, it's essentially, we've only got 37 locations booked in a PUD, as PUDs at Brooks, and 27 in our PUD resource model. Our EV to 2P valuation is trading at around 4.4 times, which is a significant discount to our peers both in Canada and on the ASX. Also note that we're an oil-rich story with an average of 70% oil. As you all know, the conversion from gas to oil is 6 to 1. So when you're looking at our peers, they have the market significantly overvalues their 2P valuation. In the US or in North America right now, the difference between oil and gas is about 15, 16 to 1, as opposed to the 6 to 1 conversion. So if you're investing in oil and gas companies, you want to invest in an oil story. And as our analysts have pointed out, we've got valuations between 50 to $1.20 per share. So this slide says it all from us. Kalima is highly torqued to the oil price. We've done our sensitivities at 3,300 BOE in the gray and 5,500 BOE in the green. First slot on the bar graph is $60 per barrel. Second one is 70, and the third one is 80. And as you can see, at 5,500 barrels of oil per day, we're going to be generating somewhere between 53 to 83 million EBITDA. This business has the benefit of having all of its capital costs mostly paid for. So we have plenty of capacity up to 10,000 barrels of oil per day. And when we drill, we get payback very quickly. So the average well recovery is between 4 to 6 months on your drilling costs, drilling and completion. A critical part of our strategy is to unlock the Montney. We have a 2C resource of 192 million barrels of oil and a 3C resource of 300 million barrels of oil. Tourmaline over the last year, together with CNRL and ConocoPhillips, have sucked up all the other players in the region. And in conjunction with the ARC and 7Gen mergers, that's $10 billion worth of acquisitions in the last 12 months. And we're the last acreage owner in the region. We have our facilities and our resources ready to be unlocked. Finally, we have the people on the ground. Black Spur has a substantial team in Canada. They've been working together for 10 years. They're a credit to the oil industry, and I'm actually really proud to be working with them. So I'd like to thank you for your time and also to introduce Jordan Keevil. He's our managing director, and on the weekend he took some video for us out on site at Thorsby.
Hi everybody, my name is Jordan Keevil. I'm the managing director of Kalima Energy Limited. And I'm here to present to you today about Kalima and our operations, particularly in the Thorsby field, where I am on site today, on the location of our main oil battery in the Thorsby field, as well as an active drilling site. We're currently drilling a well as part of our VO program, a 3-well Thorsby drilling program targeting the Sparky Formation. And we're currently drilling in the horizontal section of well number 2 of our 3-well program. I'm going to take you on a bit of a tour of the rig and the site today, as well as update you on the current operations of the company and where we are headed over the next little while. Kalima Energy has 3 distinct operating areas. First, in northeast British Columbia, there's the Montney area, which is It's a liquids-rich, gas-prone area that Kalima has 60,000 net acres of land in. Secondly, where we are today is the Thorsby area of central Alberta, where we drill the Sparky Formation, and this drilling rig you see behind me is currently drilling a horizontal well into the Sparky Formation. And our third core area is known as Brooks, where we target this Sunburst Formation and drill primarily open hole, unstimulated, conventional wells. This particular site we are on is the location of our 16-5 oil battery, and this is the main oil processing facility for our Thorsby field. As you can see, the pump jacks behind me here, these are previous wells that we have drilled into the Thorsby field, all targeting the Sparky Formation. And wherever possible, we like to drill multi-well pad locations. What that means is as many wells coming off of the same site as possible, all drilling horizontally in different directions into the field. And that really helps us minimize our tie-in costs for the wells. There's very little pipelining required when all of our existing processing equipment is already on site. We do pad drilling wherever possible in each of our fields, both in the Thorsby area as well as the Brooks area. We're currently in the process of drilling an incremental 3 wells off of this 16-5 pad, and then there will be a total of 6 wells producing into our oil processing facilities, all of which had very minimal costs associated with tying in. We're currently drilling in the horizontal section of Leo number 2, and we're currently experiencing excellent oil and gas shows as we drill through this Sparky rock. It's the Sparky cuttings right there. It's a medium grain sandstone with looks like pretty good oil shows in it thus far. Sparky wells that we're drilling right now have very robust economics at $70 WTI oil prices. The cost to drill one of these wells and complete, equip, and tie them in is approximately $2.5 to $3 million, depending on the length of the well and the number of fracs that we put into the well upon completion. At $2.5 million capital cost, these wells generate a $7 million NPV10 value, have less than a 6-month payout, and generate a approximately 500% rate of return. Here at our 16-5 oil processing facility, we're currently processing 850 BOEs per day of oil and gas. This Leo 3-well drilling program is all going to be processed at this oil battery, and we have significant capacity for growth beyond that. We can process approximately 3,000 BOEs per day of oil and gas at this site, and we also have on-site water disposal for this facility as well. Kalima is currently producing about 3,500 barrels of oil equivalent per day, about 800 of which is coming from this Thorsby field that I'm standing in right now, as well as we have approximately 2,700 BOEs per day of production coming out of our Brooks field. Our current guidance states that we will be exiting the year of 2021 at 4,500 BOEs per day of production by the end of this year. That incremental production from the 3,500 to the exit of 4,500 is going to come primarily from the drilling of these 3 wells on the Sparky Formation and the Leo drilling program that is currently active on this site as we speak. In addition to this Thorsby field, Kalima also has significant operations in the Brooks area of southern Alberta. In the Brooks area, we primarily target a formation called the Sunburst Formation. We drill horizontal wells into this conventional style rock. We're able to drill those wells, complete them, bring them on production for an all-in cost of $1 million per well. At $70 oil, those wells yield a 500% rate of return and a less than a 6-month payout per well. Kalima just completed a 4-well program in the Brooks area, the Gemini program. We drilled the Gemini 1 through 4 wells, and those wells have recently just completed their 30-day IP periods as per a recent press release from Kalima. Corporately, Blacksburg has $10 to $12 operating and transportation costs, or lifting costs, and that contributes to our very low break-even cost of $26 per barrel WTI. What that means is if oil price drops, we can continue to produce our wells in a positive profit margin all the way down to $26 WTI, which is a very low break-even cost for an oil-weighted production.
Great, thanks everyone for your time. It was a bit long, but you get the message.
Mark, that was brilliant. Thank you so much. I really enjoyed the interactive play there. That was great. Your take on the beans outside? How many?
1,426.
1426. Okay. All right. Thank you. Would you put your hands together, everyone, for Kalima. Good to see they have the same problem with flies, etc., out there that we do out here. Comet Ridge is our next presentation here at the event today. Now, Tor McCall couldn't join us. Tor is over in Brisbane, so I'm looking at the team down the back, making sure that everything is ready to go, and I will just give you his little blurb for his intro. And Tor, I hope you can hear me. So here we go. While based in Brisbane, Tor has worked on projects in Queensland, New Zealand and PNG. It included a secondment to Chevron in New Guinea. He had 11 years in Asia, where he worked as VICO's Indonesia LNG contract manager and Bintang and Cairns PLC's head of commercial in India. He is now the managing director of Comet Ridge. He was the 2013 Queensland Petroleum Exploration Association president. He is now on the board of directors for the Australian Petroleum Production and Exploration Association. Would you please put your hands together and welcome Tor McCall, Managing Director, Comet Ridge.
Morning everybody, this video is coming to you from Brisbane. Unfortunately, COVID rules beat me and I couldn't get to Perth, but I've got the job today to run you through a very exciting transaction that we've done at Comet Ridge based in Brisbane, and I'll talk to you about our Mahalo gas hub and a transaction that we've just executed with APLNG and Santos over the past several weeks. So moving through the important disclaimer and moving into the agenda, what I'll talk to you initially about is just a quick overview on Comet Ridge. We'll talk about the Mahalo gas project and our gas hub, and then just give a quick overview on our transactions that we've just executed. There's a few appendices in the slide pack that I won't get into today, just for time. In terms of the overview for Comet Ridge is an ASX listed company based in Brisbane. Our board is very experienced in CSG and East Coast gas. Martin Riley, one of our non-exec directors, was instrumental in getting CSG up and running inside Origin a number of years ago before he retired. Sean Scott was CEO of Arrow before they were taken over by Shell, and then Chris Peters and James Mackay were at Sunshine Gas, which was taken over by QGC. So I think across the board level, we've got quite a good pedigree in CSG and East Coast gas. Onto the corporate overview slide. Our market cap is about 75 million. We've got pro forma cash of 10 million, and we're in the process of drawing down a $6.5 million tranche from Pure Asset Management. And that's a transaction that we executed with Santos and APLNG around the same weekend in order to give us some forward funding for our Mahalo Hub project. In terms of Comet Ridge on the East Coast, there's a map there which shows you that we are a very large multi-basin East Coast gas play. New South Wales is not the focus of today, so I really won't get into that. I'll focus just on that Mahalo Hub area, which is inland of Gladstone. We've built over the last few years a very large position in East Coast gas, and particularly across the northern part of Mahalo Hub, where we've been able to competitively bid and win 3 new blocks over the last 2 years. We've also got our JV block with Santos and APLNG that really is the focus of today's talk. The hub gives us quite a big footprint there now. The JV block plus the 300% blocks give us a very, very big position just 240 kilometres west of Gladstone. We've also got significant upside in the portfolio with our New South Wales blocks, although there is some uncertainty around New South Wales at the moment in terms of how quickly that will get moving. We also have a big position in the Galilee Basin, and we have a 100% Mahalo Hub block that's really got quite a lot of deep high gas content coals that we'll be chasing down the track. The Mahalo gas project, the current equity position on Mahalo is Comet Ridge at 40%, Santos at 30%, and APLNG at 30%. APLNG is a joint venture between Origin, Sinopec and Conoco, and they're the party that's in the process of now selling out. Comet Ridge will step up from 40 to 70 to acquire all of their equity, and then we've provided an option agreement to Santos via a loan that will see, we believe, Santos execute their option, and the joint venture's heading towards becoming 50-50, and the following slides will run through that in a little bit more detail. There's a map there on the right-hand side which gives a good sense of the Mahalo JV block. It's the block with the two PLs. PLs are petroleum leases, which are basically a development approvals from Queensland Government. I mentioned the three northern blocks, the three hub blocks to the north that we currently hold 100%. And you can see from just the well coverage on the map that there's been quite a lot of appraisal drilling by the JV over the years. We've drilled about 24 appraisal wells. We've done 2 vertical pilot schemes, and we've done some very successful short lateral horizontal pilot wells in the shallow coals on the main fairway. And I'll mention the main fairway again in a minute. In terms of proven flow rates, we've actually established 1.4 million scuffs a day out of our Myra 6 well, which is only a relatively short lateral through about 920 metres of coal. So we've demonstrated productivity. We've been able to certify gross reserves of 266 PJs at the 2P level. So this project now has really got all the boxes ticked. And one of the issues we had was alignment amongst the JV. When is the right time to develop? And through this transaction that we're excited about, we've solved that. We now have a unified JV, if you like, with the two parties who really want to push this through and get gas production as quickly as we can. Moving to slide 10, the map there on the right, the blue map, shows where the Mahalo Hub projects sit with reference to Gladstone. As you know, Gladstone is where the 3 big LNG plants are on the East Coast, the only LNG on the East Coast. And we also have a large domestic gas industrial market there for gas. So the 2 pipelines you can see running to the south of Mahalo, one is a Gemini dedicated line for the domestic market, and the other is Santos's GLNG line for that plant. So just 65 k's of us, we have export options to get gas into the East Coast market. Mahalo, in terms of development, ticks quite a lot of boxes. There's quite a lot going for it, which indicate that it should be a very, very low cost molecule. It's a shallow coal, which means low drilling costs. We've demonstrated high productivity per well in a couple of the pilot wells up on the fairway. We see very low water production, which is typical of the Bowen, southern Bowen coals. They generally have low porosity, which leads to low water production. We've seen no production fines. We've seen no clays or any particulates in our gas stream, and that bodes well for workovers and OPEX down the track, keeping things fairly cheap and cheerful. The other point is we've got about 0.05% CO2, so we've got really no impurities to speak of. So it's virtually a sales spec gas. It's about 98 or 98.5% pure methane. Through the PLs, through the petroleum leases, we're fully licensed to develop. So last year we were able to achieve our federal and state government environmental approvals in the first part of the year. We got our petroleum lease from the state government in June. And so virtually we have a project here now where we can push the go button as soon as the joint venture is ready. And there are a couple of final pieces of appraisal we need to do that we'll be starting in the next 6 weeks or so. And that leads us into a very good position to be able to move to FID from the middle third quarter of next year. The other point I mentioned before, we're close to pipelines and markets, so we really only have about 65 k's to go to infrastructure. Across to the next slide shows the green U-shaped high productivity fairway. So what we found at Mahalo through experience, through drilling, is that the wells drilled up on the fairway, and the fairway is any coal that's shallower than about 350 to 400 metres. Wells that are drilled up onto the fairway tend to be productive. They tend to have a very good permeability depth relationship. Wells that are drilled down the flank tend to be a bit tighter, and they're going to need longer horizontal wells, lateral wells, and potentially 3 fingers like a trident style well. So our development concept is to stay up in the shallows initially, get the project up and running on the basis of the highest productivity coals, and then work into the deeper coals later on. I guess the mining analogy would be, grade, stay up where the ore grade's the highest, and then move out into the flank stuff later on once the project's up and running and you're maintaining the throughput or the gas production, if you like. So the initial development will stay in the green area. This provides, the deal we've done provides us for an option and access to bring 2 of our northern blocks into the project. So we see the project getting bigger. From initially we were thinking 60 to 80 TJs per day was where we may end up. It's looking now like we can go higher than that, given we have additional area, and the project through the transaction I'm about to go through gives us a bigger gas project. This makes it capital efficient, and it means the project will be coming into the market at a great time for the East Coast. Not really enough time to talk in detail about the East Coast gas market, but the market's getting very, very tight, and we see Mahalo coming into that market at exactly the right time. In terms of section 3, which is just really an overview of the transaction that we've just done, we have just signed up with Origin, APLNG's upstream operator, that they will sell their 30% equity to Comet Ridge for $20 million. That transaction is a $12 million upfront payment and an $8 million trailing payment. That is binding, and we're working through the CPs now, and we expect to have the ministerial approval and the other bits and pieces that we require for that concluded by about November this year. So on completion of that, Comet Ridge will hold 70% and Santos will still maintain their 30%. I mentioned the consideration of 12 plus 8. The metric on this transaction is excellent at 25 cents a gigajoule for 2p. So it's a very, very good deal in terms of the 2p, 3p reserve that we're buying. And as part of the transaction, we've agreed that Santos will be the development operator for the Mahalo Hub development, and they will bring their modular low-cost approach, which they've applied at Scotia and Arcadia and other places. So we're looking to get a very, very low-cost fit-for-purpose molecule into the network. In terms of the back-to-back arrangements with Santos, what we've agreed with Santos is in order for them to have an option to enter the project at above their 30% level, so we've agreed that 3/7 of the transaction we've done right now, we will assign to Santos. Santos have an option now to purchase that 3/7 for providing the loan funding to Comet Ridge. And once the transaction settles in about November, Santos have 6 months to exercise that option, although we expect they won't take that amount of time. We expect Santos to exercise their option sooner than that. So if you like, the transaction with APLNG Origin is simply just a buyout of a JV partner. The transaction with Santos is a corresponding back-to-back option loan arrangement, which allows Santos to take some of the equity that we would otherwise be getting and will leave us as a 57-43 joint venture, Comet at 57, Santos at 43. Now, there's a second phase to this, and that is a negotiation for Santos to move from 43% to 50%, for Comet Ridge to move back from 57 to 50, and also for Santos to enter 2 of those northern blocks that were on the fairway map before. So in order to make the project bigger, the logical place for this to get to is for Comet Ridge and Santos to have a 50-50 joint venture across all of those 3 blocks, unitised if you like. Now, the commercial arrangements around that second phase, where Santos moves up to 50% in all 3 blocks, are being worked through at the moment. They haven't been agreed yet, and we expect it could likely be a farm into those blocks through work program and perhaps also cash considerations. So we hope to be able to inform the market a bit more on that over the coming weeks and perhaps a couple of months. In terms of the transaction, we're excited to get a line JV. We've had a JV where the 3 of us have had different views at times on when we should FID and when we should bring gas online. Origin have been particularly successful and have overproduced, and their announcements or their update to market in August showed that Talinga, Arana, there are a number of fields that Origin have that are producing very well. And our concern was that with their overproduction, that the FID date for Mahalo, the first gas date for Mahalo, would slide. So this transaction brings Santos and Comet into a joint venture targeting the 50-50 level and allows us to move forward on the project and get a much larger project to market. In terms of the key highlights really coming to the end now, Comet Ridge is acquiring the 30% of APLNG Origin share of Mahalo to go to 70%. We expect to step down. We expect Santos will exercise their option and will initially fall to 57% and then to 50%. Santos, in exchange for that option, is providing a loan package of $13 million, which allows us to fund the first payment to APLNG. The transaction really unlocks Mahalo. It gets us aligned in a two-party joint venture. It brings the northern blocks in, and it gives us an increased 2P, 3P reserve base to start with. And our plan over the next 6 to 8 months is to drill some pilot wells and move ahead to book 2P and 3P reserve in those northern blocks. And the key point is that this project is then looking to come to market at a time when the East Coast is getting very tight. Molecules are hard to find in Queensland and New South Wales and Victoria, and getting harder. And so the timing for a Mahalo hub development is looking like it will fit quite well into the market. In the pack there's some appendix slides. We've done a back-to-back corporate transaction where we've got a $10 million loan facility, which is tied to warrants, initially vesting at 16.5 cents. And there's a bit more to read there in detail, but not enough time to go through it today. So thank you very much.
Well wrapped. Indeed, well wrapped. Thanks, Tor McCall from Comet Ridge. And while we have those tech gods on our side, our next potential investment option for you at Good Oil for 2021 is Warrago, and they're coming to us from Melbourne today. But as with Tor and Comet, they have ensured that they have boots on the ground here at the conference. And to that end, I'd like to invite Kathy McKegney from Warrago up to the stage. She'd like to do the honours.
Thank you. Good morning, everyone. I'm Kathy McKegney. I'm the General Manager Commercial here at Warrago Energy in Perth. Today we've got a pre-recording from our CEO Australia, David Biggs, who's actually based in Melbourne, obviously locked in Melbourne. So through David's presentation today, he'll be going through our two key assets here in Western Australia. And just as you say, boots on the ground, I'll be here at the conference all day today and available to discuss any of Warrago's activities anytime during the breaks if anyone would like to have a discussion. And with that, I'll just leave it to the recording for David.
All right, let's see how we go.
Good morning, ladies and gentlemen. My name is David Biggs. I'm an Executive Director and CEO Australia of Warrago. Just quickly, the compliance statements, we've all seen these before, we have to put them up. And then turning immediately to our first priority, health, safety and environment. And as you can see, Warrago's performance record in 2021 was excellent, zeros in every single category. Turning now to the exciting exploration potential in the Perth Basin. The other block, apart from the much talked about 469 in WA, onshore Perth Basin, that we hold is the EPA 0127, which is to the north of 469. It's a massive block. It's the largest onshore Perth Basin exploration permit application, 2.2 million acres, and it spreads across the Kalima sub-basin of Western Australia. It's close to infrastructure. Native title negotiations are in an advanced stage, and the work program and budget's been submitted to DEMIRS for review. We've also received farming inquiries from a number of potential partners, and currently data room access has been provided to 3 interested parties on a confidential basis. 127 links the Perth and the Carnarvon basins. In our view, it holds multiple West Erregulla-sized prospects and leads with the potential for liquid hydrocarbons. It's a relatively unexplored link between the Perth and the Carnarvon basins. We can identify structuring. We think that there is a reservoir quality and potential source rocks in the deep kitchen. A GIS project database is nearing completion, and in summary, we see the potential for Waitsia West Erregulla analogues in this very large and interesting block. Early Permian rocks are present in 127. Extensive Waitsia sequence and equivalent sediments could extend over 900 kilometres from the Merlinley sub-basin to the North Perth Basin. So you can see why we're so excited and so interested in this interesting exploration opportunity in 127. And I think it also speaks volumes that we've had a lot of farm and interest as well. Turning to 469, the upside there, the joint venture will undertake a 3D seismic survey in FY22 over the remaining 2/3 of the permit. to define more existing structures and to tie to the West Erregulla 3D. We're targeting near-field structures with potential for tie-ins to the West Erregulla gas project at some stage in the future. The processing of the 3D is expected to be completed by mid-calendar 22. Turning now to the 469 appraisal campaign. The appraisal wells, all of them, are to be completed for future production. As you will know, we've drilled 3 appraisal wells, 3, 4 and 5. The drilling commenced in 2020. We've worked closely with the operator to improve drilling performance with each well, culminating in a revised well design for WE5, which saw that well drilled in record time for the joint venture. Current field modelling incorporates excellent results from the central area wells. We've seen excellent reservoir quality across the Kingia Forest unit. We've got a consistent field-wide pressure regime, and gas composition appears consistent throughout the field. We've also seen increased overall gross rock volume in the field as we have drilled the wells. The northern area data will be enhanced with the completion and testing of WE3 expected in the first half of 22. Turning now to WE4, this step-out appraisal well was drilled down dip on the southeastern flank of the central area. It spudded in January 21. We saw substantial improvements in drilling time and cost performance over WE2 and the suspended WE3. The well also produced low salinity water at a rate of 1,365 barrels a day. The initial low salinity water production was around 50 barrels per million scuffs until a plug was set, and it then declined to between 37 and 39 barrels per million scuffs. You would have seen doubtless the differing views in the respective ASX releases about the source of that water. It is still, in our view, undetermined. The good news, however, is that the gas composition is similar to WE2. West Erregulla 5, an appraisal well to the north of the central area, situated between WE2 and the northern area boundary, spudded in May. The best drilling performance that I've mentioned to date, and we saw a Kingia gross thickness of 183 metres with a net pay of 32 metres and an average porosity of 10%. WE3, we suspended that well earlier this year, and we plan to re-enter in the first half of 22. It was spudded in September 20 and was subsequently suspended in January 21, and the cement plug set after it encountered high pressure readings in the Carnarvon that were close to the well design limits. We've subsequently determined that the well can be re-entered and can remain within the design limits of the existing casing, and the joint venture is currently completing detailed engineering on a re-entry well design and the integration of a managed pressure drilling system into the rig. Procurement of long lead 13 chrome casing has commenced, and we expect the WE3 entry to take place sometime in the first half of calendar 22. Turning now to the West Erregulla gas project itself. An overview. The West Erregulla project will be the first new source of onshore West Australian domestic gas supply in some years. It contains high volumes of saleable gas. We have foundation GSAs in place with Alcoa and CSBP, and we are still seeing a tightening gas market with substantially increased spot prices. Reserves and resources, we have a 2C of 513 BCF gross, independently certified by Risk in 2020, and we are currently working with Netherlands Sewell and Associates for a further updated independent reserve certification, which we would expect to see in September, October of this year. As you probably know, ADGIG's been selected to build, own and operate an 87 terajoule a day gas processing facility for phase 1, and the procurement of long lead items has commenced. Turning now to current reserves and resources, as I mentioned, Warrago has obtained an independently certified resources from Risk for West Erregulla. As mentioned, the JV has selected Netherlands Sewell to independently re-evaluate and certify West Erregulla reserves and resources using data from 2, 3, 4 and 5, and that report is due September, October of 21. We're looking at having ADGIC build a low-cost, low-risk gas processing facility, as I mentioned. They are the preferred proponent to build it. FEED study was completed in April of this year with a competitive low-cost toll. The benign spec allows a very simple and straightforward facility, simple CO2 extraction with dewatering and compression. Warrago commenced payments to ADGIC in July of this year to commit long lead items for the construction of the gas processing facility, which should enable phase 1 of the West Erregulla gas project to maintain its mid-23 targeted first gas date. Project finance. A banking club is being formed to arrange project finance facilities on a best endeavours basis. The plan is that there would be separate and parallel facilities of 75 million Australian dollars for each of Warrago and Strike on a several basis with common terms. A banking club comprising 3 Australian banks is being formed, and the funding will allow for the upstream development, the ADGIC construction security, and reimbursement of further drilling costs, facility costs, and working capital. And as I've mentioned, the payments that we are making currently to fund long lead items as part of the overall gas processing plant development will be refunded back to Warrago once the project development finance is in place and able to be drawn. Carbon strategy, planning for the future. Warrago is preparing for a rapid growth in its activities following the approval of the West Erregulla project. In line with this transformation, Warrago is developing a carbon strategy around EP469 and West Erregulla. We're currently evaluating a range of carbon management options to help us minimise and offset future emissions. Our current emissions are negligible, and emissions associated with the gas plant itself at West Erregulla will be managed by ADGIC under the terms of the processing agreement. The WA gas market. As we've said many times, the fundamentals in this market are very sound. Gas represents 53% of energy use in Western Australia and is the majority source of electricity generation. You can see there the WA energy mix in 18 and 19, and you can also see the strengthening WA spot market price, which continues to support our view of a tightening market as we head towards 2025 and 2026. West Erregulla will become increasingly important in that tightening scenario. The tightening is driven by the decline of North West Shelf and the delays in Scarborough and Browse. West Australian gas demand remains robust and could increase significantly could the Perdaman urea plant proceed. Significant Perth Basin volumes of gas have been diverted to other uses recently. Waitsia gas has been approved for export, and any South Erregulla gas that is discovered, noting that it currently remains undrilled and undiscovered, we understand is earmarked for a possible urea plant. On that basis, Warrago is increasingly well positioned to sell its share of West Erregulla Phase 2 gas into a high demand domestic market. Our location in the Perth Basin gives us access to multiple markets. We're close to existing and new infrastructure. We can deliver into the DBP or the Parmelia. Our southern markets benefit from a low part-haul transportation cost, and the northern markets benefit from a nominal backhaul transportation cost into the Pilbara. And of course, our access to the Goldfields markets will be enhanced due to the new pipeline to the Perth Basin via APA's Northern Goldfields Interconnect. That should allow further high-value diesel replacement with Perth Basin gas. Warrago's got a very experienced team. The board and management have vast domestic and international E&P experience, including onshore Perth Basin, with significant shareholdings that give us real skin in the game. We play to our strengths. We're focused on onshore gas projects with low development risk, access to high-value markets, and ability to generate strong cash flows. We don't take commodity or complex development or currency risk. Warrago represents excellent value. It also has solid fundamentals. As mentioned, we've secured a large-scale long-term GSA with Alcoa that has underwritten the West Erregulla gas project, and we will receive a greater share of that cash flow and revenue during the phase 1 of the West Erregulla gas project due to its high value and larger volume GSA. The gas project and the gas plant is almost development ready. Long lead items are committed. The gas processing and funding agreements are pending. And as mentioned, the independent reserve certification is underway. And we are targeting first gas in mid-2023. And we believe there is substantial upside potential. 3D seismic that I've already mentioned is planned for 469. We hold 100% of 127, which is the largest onshore Perth Basin exploration permit, which is now attracting keen farm interest. Warrago itself now is building a pipeline of quality projects. The West Erregulla gas project, of course, which is development ready. The West Erregulla gas project phase 2 is already attracting interest from gas buyers. 469 new leads, as I've mentioned, 3D seismic is planned for the remainder of the 469 block in FY22. And I've spoken about the farming potential of 127 and the high level of interest we're receiving there. We're also actively pursuing other new onshore gas assets and ventures, and we'll no doubt be able to talk about those later. Near-term catalysts for the company. I've touched on most of these. The formation of a banking club, which we would hope to see this month. The WE5 appraisal retesting, again, hopefully this month. The NSAI reserves and resources report, September, October of this year. The completion of the gas plant development and gas processing agreements with ADGIG sometime in the second half of this year. And we would expect the joint venture to make a decision to proceed with the development in the second half of this year as well. 3D seismic campaign on 469 to prove up additional leads we would see in the first half of next calendar year. And on 127, we would see the native title negotiations completed and the property converted to an exploration permit in the first half of next calendar year. Finally, going back to the West Erregulla gas project, we would expect to see the EPA permit approvals and project finance become available in the first half of next calendar year. Thank you very much.
Thank you, David. Thanks, David and Kathy at Warrago. Right, we have one more presentation before we go to morning tea. Morning tea today will last for approximately 25 minutes. Gentleman's coming up here already. Wish we had like Google Box for Good Oil Conference, because I'd stick Darren up the front here with the camera on him, talking about your beloved Perth Basin, and he's been nodding to many of the presentations doing this. So if you want more good oil, I'll go and chat to that bloke too. This bloke here in front of us, Mr. Ken Aitken, would you please make him welcome? He is the Managing Director of Metgasco. He's held that title for the last 3 years. He does have experience, though, ranging back the odd 35 years. You wouldn't know it looking at the fellow up here. He's got worldwide experience in large and small independent operating oil and gas companies such as Origin, there's been Mitsui, Amarada Hess, Enterprise Oil, and also Apache, not that small, but a couple, yeah. His focus for us today is on the development of Metgasco's recent 100% gas discovery success rate from 4 wells at the Cooper Basin and their future plans to drill a large oil exploration project. Darren, in? Correct. Please make him welcome again.
Thanks, Chrissy, for the kind introduction, and good morning, everybody. And it's great to be back in person at the Good Oil Conference. Since the last conference in 2019, Metgasco has been kicking goals. And in this presentation, I'll expand on our business transformation, the strategy behind it, the exploration success we've had, and reveal why our Cooper Basin discoveries with our joint venture partners over the last 18 months, we believe, is called a string of pearls. Okay, so the business transformation. Over the past 5 years, Metgasco has transformed from being a New South Wales coal seam focused company and an offshore Gulf of Mexico explorer to discovering gas resources in the last 4 wells in the Cooper-Arramanga Basin. And we've got line of sight to production in the middle of next year. So what we'll do is Metgasco have planned to drill a large oil exploration prospect in the Perth Basin, and its on discovery would be transformational for our shareholders. I will explain how we carried out this transformation throughout this presentation. You can see the agenda. I'll go over the assets that we have, summarise the Cooper exploration success in both Valley and Odin, and also talk a bit about the East Coast gas prices. It's a terrific time to have 4 discoveries behind pipe and selling gas into a rising market. I'll provide a forward timeline of the very busy activities ahead, and then I will talk about our share price catalysts and finish with why you should be investing in Metgasco. So the company snapshot. Metgasco is an ASX-listed small-cap oil and gas explorer and soon to be a appraiser and developer. We're 17 million market cap and has been listed on the stock market since 2014, ticker code MEL. Metgasco have a highly experienced small team of 2 executives and a board. And I'd just like to welcome Peter Lanson, a very experienced executive who will work with an Origin, who's joined the board recently. We have a quality portfolio of exploration and appraisal assets, and in my view, they are in the best 2 onshore basins in Australia, the Cooper and the Perth Basins. We have just raised $4 million in a recent rights issue, and we have a new look shareholder register, and I'd like to welcome Glennon Capital, who's on the slide as a 10% holder as a new investor. Okay, so you can see the map of Australia there. We're focused on gas in the East Coast, although there are some oil prospects as well in the Cooper Basin. We've drilled, as I said, we've drilled 4 gas discoveries in the last 18 months on the 2 non-operated permits, mainly on ATP 2021, or a 25% ownership with Vintage as operator, and PRL 211, we have a 21.25% ownership. More details coming up on the East Coast assets. We're 100% owner of the ATP 2020 license, and I'll talk to you briefly about a farm-out opportunity there. So we've also got focus in the Perth Basin. Now, most companies at the moment are chasing deep gas. I've always been one to think a little bit differently. We're chasing shallow oil, and that was an asset that we farmed into a couple of years ago. Within 2 months, we farmed out the position we took to Vintage Energy, our operator in the Cooper, and we are paying 50% for a 30% interest in that well. I'll talk about the strategy rather than the details of the individual permits that you can see on the slide here. Our strategy is to deliver shareholder returns and be the partner of choice. Since 2016, Metgasco has returned nearly 20 million in cash and buyer and equity in shares to our shareholders, and we've delivered in building a strong reputation on being the partner of choice. Now, how did we do that? Basically through strategic farm outs and farm ins, and building our Cooper Basin position in ATP 2021, PRL 211, and in the Perth Basin. So drilling a little bit deeper into Valley, you can see in the top right the map of Valley. Valley is in that very top right of the map, and you can see PRL 211 and ATP 2021. So I'll talk about Valley. It was discovered, first well was discovered gas in January 2020, when most people were worrying about the pandemic hitting us. And we then stimulated and tested the well in August 2020. The reserves in the table to the bottom left, you can see gross are 33 petajoules with 8.3 petajoules net to Metgasco. So what is made up this year in calendar year 2021? We drilled 2 wells, Valley 2 and Valley 3. Valley 2 discovered almost double the amount of net sand that was discovered in the Permian sands of Valley 1. And Valley 3 was an even greater discovery with 178 meters net pay. And that's low perm and conventional gas included, down to 6 or 7% porosity. I'd like to thank operator Vintage for delivering a safe and successful drilling program this year. You can see the gas flare in the picture on the slide. So back to the string of pearls analogy. So there's more in this ATP 2021 license. You can see a number of leads in blue, oil leads, and in light blue, gas prospects. So we think what we've got here is a number of medium-sized gas discoveries, and we'll build both by shooting seismic and drilling the Kinta well to add an extra string to the pearl to make this quite a sizable and profitable gas project. The development plan is to install a gas pipeline. You can see on the slide in the dotted line. It's running from Valley due west and then down to the Santos operated Beckler field, but the gas would then be taken through the Moomba facilities, and we'll obviously be putting together a processing agreement shortly with Santos. It's a 9-well development, about 5 BCF of raw gas recovered from each of the wells, and it'll be a 20-year field life. Startup rate would be around 12 million standard cubic feet a day, and the first gas is expected at the end of the first half of next year. Now, that we strategically farmed into the Odin prospect in PRL 211, and the reason was that the structure itself crossed the boundary of the license and state lease line, and we wanted a bigger piece of the pie on Odin because we saw it as a very, very interesting project. And we were right, because in May we drilled the gas discovery well successfully, and we found 172.5 meters of gas pay, which was a really fantastic result for all companies involved and the shareholders. We recovered gas samples and logging tools in the Talachi and Epsilon reservoirs, and we expect in the next week or so to be announcing the independent reserves study by ERCE, which is underway, and we're hoping for a significant increase in resources to those seen in the table below. We expect a high side estimate, but we'll wait to see what independently we get there. But overall, a terrific result for all involved. So moving over to the Perth Basin, I have a long history, and almost as long as Darren, I think, in the Perth Basin, and it's very underexplored, as Darren was talking about this morning. The recent focus has been on gas, but as I said earlier, Metgasco chasing a large oil play. In 2019, we farmed into the RCMA license L14, which includes the Jingamaya field, which I ran for 7 years. Origin stopped exploring in the Perth Basin due to priorities in coal seam gas in Queensland, and what this has done, it's set up an opportunity, and that's the reason I farmed in. The oil trend fairway you can see in the green line on the map shows the Cervantes structure adjacent to the Jingavaya field, which had 12 million barrels overall in place and recovered about 5 million barrels, most of which when I was operating that facility. And overall, in that green trend line, 27 million barrels of oil have been produced within the fairway over a 20-year period. And Cervantes is a 28% chance of success of a discovery, but there's three zones that are in that well. You can see the Jingamaya 1 well section. The reason I like this so much is Jingamaya 1 found a really good Kingia Highcliffe, drilling the discovery well in 2003, and at that point it was forgotten about because the Dongra oil was discovered. Just looking at a cross-section, a seismic cross-section, you can see some fields that you know and love. I've circled the three Permian sandstones that we're targeting. It's the shallowest Kingia Highcliffe in the basin, but it's on a trend with the very productive Kingia Highcliffe reservoirs as you push out through to the northeast and due east of the prospect. So P50 prospective resources in the Cervantes project is 50 million barrels of oil. Interestingly, Risk actually did some independent work and figured out there were 17. So we're being quite conservative. So I'm hoping can be one of the successes that Darren was talking about earlier today when we drill this well. We're looking for a rig slot on one of the Perth Basin active rigs at the moment. We hope to be drilling the well towards the end of the Q1 next year. So can we sell both the gas over east and the oil that hopefully you'll find in exploration? It's a fantastic time to be involved in marketing gas on the East Coast. I think some of the presenters have been saying the West Coast is a rising market. The spot price was up to $20 a gigajoule over east. So having a sizable gas resource and selling into that market is very attractive at the moment, and we're in the processes of putting together a GSA. We're looking at different gas prepayment options, as well as companies want to put the pipeline in. The 12-kilometre pipeline can be installed off the balance sheet, which is good news. We reckon we get prices of around certainly $6 to $8 a gigajoule and a long-term contract, maybe more, and certainly we'll be keeping some of the gas for a spot market in the middle of next winter, where it was up to that $20 a gigajoule. Oil prices at the moment have recovered since the pandemic, and they're sitting about $70 a barrel, and certainly selling oil is not a problem as well, and it can very quickly commercialized. So a project timeline is a busy slide, but we have been busy, we've been successful, and also we've got a lot to do in the 3 key assets that we own. So in Valley, we'll be getting a financial investment decision in the JV. We'll be completing and testing wells early in Q1 calendar year 21, installing the pipeline to Santos's facilities, and expect first gas in June next year. On Odin, once the resources are announced shortly, we'll be hopefully testing the conventional reservoirs at the top of the reservoir, the Epsilon and the Talachi, and we'll be completing that well along with a campaign in early Q1 calendar year 22. And following JV approval, we hope to put the Odin field into the Valley pipeline, as it's running pretty much past the lease. On Cervantes, we'll get a rig slot approved, and with a letter of intent, we'll get our government approvals, which are progressing well at the EPA, and then we'll drill our well, as I said, next year in Q1. Very quick plug on we own 100% of ATP 2020. Metgasco were granted we gazetted this license back in 2016 and were granted the ATP in 2018. It's a large underexplored license, minimal drilling since the 80s. We hope to work our magic wand on this prospect as well, and we're looking for a partner. We reprocessed the seismic, and we've identified a really shallow dual oil and gas prospect called Lockie, which I think there was a movie recently brought out on Lockie, so good timing there. So with 6 million barrels of recoverable prospective resource and 13 BCF of gas, and one well, a slightly deviated well, can access all 3 of these reservoirs. Metgasco have had a number of parties reviewing this data room. We do hope to secure a farming partner to drill either a well or shoot seismic, as the case may be. So please come to our booth to discuss this opportunity if it interests you further. So in conclusion, we've got a number of share price catalysts. A lot of them have been mentioned already. Certainly the reserve upgrade in the Cooper are imminent, and we expect a significant one in Odin, and certainly a move up on the Valley field as well. We'll be signing gas sales agreements and looking at different funding options for the appraisal and future development of the Valley and Odin fields. And then there's the financial investment decision, and over in Perth, signing that rig slot and getting all of the approvals in place. So what I'll do is I'll finalize. I need to go back. How do I do that? This one? Yeah. Why should you invest in Metgasco? Metgasco represents compelling value. Metgasco is significantly undervalued versus the reserve and resources and opportunities that we have, exploration opportunities available, and therefore represents compelling value. We have delivered on a business transformation, creating value by astute deal making. The strategy of shareholder returns and partner of choice has been delivered, and I've shown you that earlier. No value has been given to our huge oil exploration prospect, and Metgasco board and management are very focused on project delivery and new opportunities. I'll show you the final disclaimer slide, and I'd like to thank the RIU for the opportunity to present today, and I look forward to updating you next year with some more successes. Thank you.
Thanks, Ken. Ken Aitken presenting for us, our final speaker before morning tea. I didn't want to leave you, Ken. And just for your information too, where are you from in Scotland?
Stirling, Central Region.
Do you have a kilt?
I do.
Excellent, because on the 3rd of October, I'm covering for another little gig that I do, the annual kilt run. Do you go?
I'll try. It sounds good, as long as it's not windy.
So you can go and catch up with him there if you can't catch him out at the booth. Everyone, we've got a 20-minute break for morning tea, then we'll be back with our next 6 presenters. Could you put your hands together for all our presenters in our first session for Good Oil?